Namaskar, friends. Welcome to Money Managers, where we help you make your money work for you. Today, we are decoding one of the most awaited IPOs of the year, NSDL or National Securities Depository Limited. Should you invest? What are the risks? Let's break it down simply, clearly, and in a retail friendly way. NSDL is India's first and largest depository, created back in 1996 to eliminate paper share certificates and digitize securities. If you have a demat account, chances are your shares are stored safely with NSDL or its rival CDSL. NSDL handles the electronic storage, transfer, and settlement of your stocks, bonds, mutual funds, and more, and supports over 3 crore demat accounts with a massive 430 lakh crore worth of assets under custody. Think of it as the safe vault of Indian capital markets. NSDL earns money through transaction fees, which is charged every time you sell and buy securities, annual maintenance charges, services like e-voting, e-KYC, and payment bank operations via NSDL Payments Bank. It is a fee-based, asset-light, and high-margin model with little competition. Once infrastructure is built, scaling is easy, which means excellent operating leverage. The industry is growing fast. Over 150 million demat accounts, surge in IPOs, SIPs, and equity trading. SEBI is also pushing for full digitization. T plus one settlement and eKYC mandates are strong tailwinds. NSDL, along with CDSL, enjoys a duopoly in this booming space, but NSDL dominates in value, holding 89% of total securities by worth. Its main competitor is CDSL. While CDSL has more retail accounts, NSDL is the preferred partner for institutions, large brokers, and custodians. So, what are the risks? Regulatory changes, tech disruptions, or cyber threats, and NSDL being 100% dependent on capital market activity. But the business has strong trust, a SEBI monitored framework, and deep integration with financial institutions, which builds a strong moat. Let's talk numbers. Revenue growth at a CAGR of 13% over 3 years, EBITDA margins over 50%, PAT margins around 44%, a return on equity of 17.4%, and an ROE of 23%. Zero debt, positive cash flows, healthy dividends. This is a profit making, cash generating machine and not a loss making startup. This IPO is a pure offer for sale. That means no fresh funds to NSDL, just existing investors exiting partially. The price band is between 760 to 800. It trades at a P multiple of 38.5. Grey market premium as on today is 100 to 120 rupees. Compared to its peer CDSL, which trades at a similar multiple, NSDL is fairly valued, or you can say slightly premium. But its institutional focus, brand, and tech edge justify the PE multiple. NSDL is a professionally managed company, no individual promoter. Top shareholders include IDBI, NSE, SBI, HDFC, UTI, etc. The board has independent directors and former regulators with no pending litigation or auditor concerns. Corporate governance is clean and strong. Strong interest is expected from anchor investors, especially mutual funds. The IPO is seen as a quality compounding story, not a speculative bet. With limited number of shares on offer and strong demand, a listing gain looks likely, although valuations are not cheap. Should subscribe for long-term or listing gains. A monopoly-like player in a duopoly industry. High margins, high return on equity, and steady cash flows. It is fairly priced with a strong demand outlook. Ideal for investors who want steady compounding, low risk, and regulatory tailwinds. If you found this breakdown helpful, hit the like button and share with fellow investors. For more insights on IPOs, mutual funds, and financial planning, follow Money Managers. Until next time, invest wisely and stay financially fit. Thank you.